Welcome to this video designed to give you an in-depth understanding of a key financial metric, dividend yield. Whether you're a student or a finance professional looking to sharpen your real-world applications, this concept is critical for making informed investment decisions. Right now, we'll break down how to calculate and interpret dividend yield, one of the most important ratios for income-focused investors. So let's dive into the world of dividend and market analysis as we look graphically into this fantastic ratio. Let me share my screen quickly as is our custom, and let's look deeply into this fantastic metric. I've got median yield as usual. This ratio expresses dividend per ordinary share as a percentage of the market price per ordinary share. So the dividend per share calculation has been done in previous videos. And the market price per share are the components we use to calculate this dividend yield. We want to see how the dividend declared and calculated is in comparison to the market price per share. So we want to see how much dividend per share would relate with the market price per share to see the yield of the dividend of shareholders compared to the market value of the shares in the stock market. It's calculated as the dividend per ordinary share divided by the market price per ordinary shares. It's a financial ratio that shows how much a company pays out in dividend each year relative to its stock price. It's a key metric because income-focused investors who are interested in generating returns through dividends rather than capital appreciation. So two kinds of investors. We have the dividend-driven investors and the capital appreciation-driven investors. So those that are driven by dividend want to know the market value of their shares and its appreciation over time. So it allows investors to compare the income generating potential of different stocks, especially in the stock market. So graphically, we also have the formula again: dividends per share as the numerator, market price per share as the denominator, where dividend per share has been calculated as the total dividend divided by the number of ordinary shares, and the market price per share is given in the question, where we have capitalization and the market value of the share provided in the financial statement. So let's calculate this ratio briefly. Let's see how it relates. So we've taken the dividend per share here as 28 kobo and come to the dividend yield to post here as the dividend per share to calculate the dividend yield. So let's go to the financial statement to get our market price per share. Now, there's a caveat here in the first note that states proposed share price in the Nigerian Stock Exchange is 5 naira per share. So let's take this 5 naira as our market price per share, which actually is. I'll come here and post it as 5 naira. So this is our market price per share. Excellent. So now, in calculating our dividend yield, have it as our dividends per share divided by our market price per share. And we have it as 6%. 6%. So our dividend per share is 6% of our market price per share. Quite low, but let's see what this means. What does this mean? Dividend yield here presents the percentage return an investor earns from dividends alone based on the current stock price. So from what we calculated for Sharubutu Nigerian PLC, you can see the dividend yielded only 6% of the market price per share. The higher dividend yield indicates that the company is paying a higher proportion of its share price as dividend, making it attractive to income-seeking investors. But in this case, you can see 6% is quite low, while the implication is that a high dividend yield suggests the company is returning a significant portion of its value through dividend. While this can be appealing, it may also indicate that the stock price has dropped in the market, possibly due to market concerns or declining prospects. So we have the market value of the share in this example as 5 naira, and we have 28 kobo declared in the 2020 financial year, their financial statements. So the dividend per share of about 28 kobo compared to the market price per share is just 6%. So you can see it's not really appealing in this case. While a low dividend yield, like we see, may suggest the company is either reinvesting earnings into growth or its stock price has increased significantly, reducing the yield, which to some extent is this case where we have 28 kobo in dividend declared for that particular year, and market price per share is about 5 naira per ordinary share in the stock market. So what is the cause and effect? Cause and effect of a high dividend yield is company in mature industry that prioritize returning cash to shareholders for significant drop in the stock market price. So where companies in particular industries prioritize returning cash to shareholders is enshrined in their policy. You see that most of this cause a high dividend yield. Also where we have a drop in the stock price in market. So for example, we have 5 naira for the shareholder 2 example we just calculated, where the share price maybe dropped to 2 naira or 3 naira. You see that the percentage in the DPS has increased. So these are the possible causes of a high dividend yield. The effects are it attracts dividend-focused investors, but a very high yield may be a red flag indicating financial instability or slow. A low dividend yield is caused by companies focusing on investing in earnings for growth and expansion, or have strong stock price appreciation, which to some extent is Charlotte's case. While the effect is it may appeal to growth investors looking for capital gains, but it can deter income-seeking investors at the same time. So in conclusion, the dividend yield is a crucial indicator for investors looking for steady income through dividends. It helps assess the effectiveness or attractiveness of a stock based on the dividends, if pays, or stock based on the dividends, I beg your pardon, it pays relative to its price. While a high dividend can signal good returns, investors should be cautious, as it could also point to declining stock prices or other issues. So, dividend-driven investors should be very careful. Accountants, chartered accountants should be able to advise on how this ratio impacts or explains the pros and cons of a high and a low dividend very, very carefully to investors. A balanced analysis of both yield and company fundamentals is essential for making informed investment decisions. This is very critical. So we must balance our analysis to know what are the aim objectives of these investors. What do they tend to what are their needs in the long and the short run? So advice could be provided very, very objectively to them to make informed decisions. This is very, very important. Okay, thanks for watching. And I hope you found this breakdown of dividend yield helpful in your studies, professional career. Whether you are preparing for your exams or applying this knowledge in the office, understanding how dividends impact investment decision is crucial. Don't forget to like, comment, and subscribe for more insightful videos, and share this with fellow students and professionals. Until next time, keep learning, stay informed, stay financially savvy, and always make those smart financial choices. See you in the next video. And until then, bye for now.